Have you ever felt like no matter how much you hustle, Uncle Sam always takes more? Well, in 2026, it's about to flip that script. And if you don't get ahead of it, your tax bill could wreck your legacy. I'm Mario Payne, your favorite certified financial planner, and today we're talking about the 2026 tax brackets, deductions, and rules that will never be the same. By the time we're done, you'll know what to watch for, what to prepare for, and how to keep more money in your pocket. Y'all ready? Let go! Now, before we get started, as always, like, subscribe, and share to our channel. In real life, I'm a certified financial planner helping thousands of people worldwide on these social media airways. We're just giving information, not a recommendation. And past performance doesn't guarantee future results, but talk about the past. It won't be the present or future because of the big, beautiful bill. And now with the tax brackets changing, your pockets is going to be a hurt. And the reason why is because the IRS dropped the 2026 deductions and the changes. And here's what it is, you guys. The bracket adjustments look like raises, but inflation has already ate those raises away. But now it's a boost to the estate planning deduction, the death tax. It used to be $13 million, meaning if I was single, if I had $13 million or less, it passes down to my family and they don't pay any estate taxes. Now it's $15 million. So $2 million more, $15 million passes down to the family. If I'm single, they don't pay any taxes. Married, now $30 million. A lot of money that passes down. That's why it's important to use the relaxed estate and create your trust, your will, and your power of attorney so it flow through your trust and we can take advantage of that exemption. And it's also extra deductions for seniors who are 65 and older. A rare win, but with some caveats we'll talk about. Changes to business deductions and phase out for service-based income. You know, tax on tips. We thought that was a good thing, but they took it from somewhere else. Tweaks to credits, the child tax credit, that $2,000 we got per child, that's reduced now, my friends. Earned income credits, that's reduced as well. This will shrink payouts for every single family. And these are not small tweaks. This is actual structural reset at its finest. It's going to impact everybody, from business owners to everyday to employees. This is why it's important to have a tax strategist. You see, a tax preparer, they'll just prepare your taxes as is with the new changes. A tax strategist, he or she will look at these tax brackets, look at the changes, and see how we can take advantage and not be at a disadvantage. But let me tell you why I say it'll never be the same. Number one, the sunset clauses. Many favorable rules from the recent tax years expire in 2026. Overnight is gone like a thief in the night. And number two, tax bracket creep is real. Even if you get a raise, you're still often going to end up paying higher because the tax bracket shifts won't match what inflation's doing. And number three, the shift in power. The IRS, yes, the IRS. They're giving goodies in one line, and then the other line, they take it. It's like Robin Hood. Steal from the rich, give to the poor. For example, seniors get extra deductions, but at the same time, income thresholds and phase outs tightens up their wallets. And for business owners, deduction caps. Yes, a cap on your deduction. And for my service base, which means you might owe more even with the same money that's coming in. How is that possible? I make the same, all these tax cuts, but I pay more in taxes? So who's going to feel the hardest? Doctors, lawyers, consultants, coaches, your service income. They are the first on the chopping block. You see, entrepreneurs count for about 20% of pass-through deductions. But those pass-through is sinking like the Titanic. Families with kids, those tax credits is shrinking and quietly being replaced. Retirees, seniors, while you might get an extra deduction, the changes in those taxable thresholds could cost you when it comes to pocket share. Buying power is how much money we have to spend. Last year, I had $100. Interest rates was high. My money market made 4%. That's great. Inflation is at 6%. So my buying power goes down by $2. Yes, I made 4, but inflation's 6. So now it costs me $2 extra to buy the same thing I'm buying now. How does that help me? It doesn't. Mid to high income earners, you're in danger as well because you're too rich and you're not normal enough to escape the high rates. High to mid income earners, you're in the danger zone, my friends, because you're too rich to get help, but too normal to escape the high rates. That's why, again, it's important to have a tax strategist, not just a tax preparer. You see, if any of those categories are you, it's not theory. It will affect your bottom. So here's how we're going to break down the 4 buckets. Bucket number 1, bracket changes. Yeah, income bracket changes without inflation. I want to give an example. For all y'all party goers out there, it's 2 lines outside that club. In the club, 2 lines. VIP line, general admission. You're stuck in general admission and you see VIP moving. That's not fun. Well, that's a bucket when it comes to the tax brackets. Or all my roller coaster goers out there. You go to amusement park. You go to Disney. You got that fun pass? Nothing is worse than being in the front of the line, about to get on that roller coaster I've been waiting all day to get on, and 8 more people hop in front of me because they have the fast pass. That, my friends, is what it feels like with the tax brackets, because the rich, the wealthy, and elite doesn't really affect them at all. But with the rise of the tax brackets and the income associated with it, we're literally making the same money that we're making now, less deductions, and more money out of our pocket. So long story short, you will get pushed into a higher tax bracket and prices raise. You're screwed both ways. Bucket number 2. It's a good bucket though. Estate and transfer windows for you. As I said before, with the exclusion being raised, folks are able to have now sizable assets to shift into a trust without being knocked over the head when they die if they have less than $15 million in assets. Creating a revocable living trust, not a recommendation, but information, will allow you to do that. An irrevocable trust will allow you to do that as well, but you can't take that money out. You can't change an irrevocable trust. That's why typically, especially if you are under that $15 million threshold or married with less than $30 million, revocable living trust might be the way to go. Not recommendations, not legal advice, but we do have the Relaxed Estate, www.therelaxed estate, that can help you specifically answer those questions. But that is a good thing. So bucket number 2 is good because we get to pass down more money, up to $2 million to $4 million more money, and not pay federal estate. Then we have bucket number 3, deduction and credit tweaks. The extra $6,000 deductions for seniors, that's powerful, but only if your tax strategy matches your income. Credit cuts for kids or lower earned income thresholds will surprise many. We thought because of the big beautiful bill, it was this huge tax cuts. But as I said before we got a $2,000 credit. Now it's $1,500. Now what's a credit and what's a deduction? Because we get that question all the time. A credit is actually money that they give you. If I get a $2,000 credit, that's $2,000 that the IRS gives me. Now a $1,500 credit, that's $1,500 that the IRS gives me. A deduction, a little bit different. A deduction is it decreases your tax liability. If I make $100,000 and I get a $2,000 deduction, now I'm not taxed on $100,000, I'm taxed on $98,000. So I'm not getting $2,000 in my pocket. I'm just reducing how much I'm going to pay. So tax credits, in my humble opinion, are a lot more important than actual tax deductions. This is why it's going to be so many people that's upset, because it's real money being taken out their pocket with the tax credit. And for business owners, now relying on tax deductions to help offset gains and grow their business. It's not going to happen anymore because of that cap. Again, another reason why you should hire and retain a tax strategist, not a CPA, not a tax preparer. Nothing against them. You still want to use them, but have your tax strategist first create those strategies and then have the CPA and the tax preparer do your taxes. And bucket number 4, business rule tightening, especially for service-based businesses, bartenders, hair salon, barbers. Service-based, no tax on tips, right? Yeah, no tax on tips, but more phase outs and limits to deductions that you can use to write off. So yes, you're not paying no taxes on tips. But if I'm a barbershop owner and I'm used to deducting everything, now it's a cap. It's a limit on what I can deduct. So yes, I am not being taxed when I get tips, but I'm not able to write off nearly as much stuff. I'm still paying more taxes. How is that possible? All my tips are not taxed, but I'm still paying more taxes? Yes. The devil, my friends, is always in the details. And I'm going to give you bucket number 5, a bonus, a sunset trap. Many of today's rules expire, and what works now might be illegal later. So again, a tax strategist is important to make sure what does expire you take advantage of today. Now, okay, the doom and gloom is past us. Now we need a plan. I'm going to give you some key steps to make sure you're not affected in a negative way with the tax bracket changes in 2026. Number 1, audit your current structure. How much income are you getting? And how vulnerable you are in these categories, and what can we do to shift income to make sure that we are in lower tax brackets. Number 2, accelerate favorable moves. Roth conversion. Backdoor Roth IRA. Do you know what that is? That's when we pay taxes now, and then the money goes to a Roth IRA, and the money grows tax-free after. A way for us to take advantage before the tax brackets in 2026 come into place, and now have our money grow tax-free after. Number 3, lock in estate planning today. Create a trust. Do your estate planning. Gift everything before the rules change. Number 4, streamline your offers and streamline your business. Shift more revenue into safe categories. Products versus services. How are they taxed? LC versus S Corp. How are you taxed? If I make more than $3 million a year, S Corp to C Corp, how are those taxed? Number 5, prepare for the pushbacks. What pushback? Well, in the big, beautiful bill, which they did not talk about, is that they gave billions with a B, billions of dollars for audits, because they know if they cut taxes, it's less revenue, and the federal government runs on revenue. We're not a business. We can't increase things, but we can make sure we decrease how much taxes you're not paying. So it is a lot more people every single year starting in 2026 that's going to look at your returns. What red flags do we have? Documentation, documentation, documentation. If we're doing the Augusta rule, that's great. But if we don't have the board of directors document, if we don't have the meeting minutes every 4 weeks because we're doing it 14 times out the year, we can get into some trouble. You're doing a home office deduction, but you don't have a lease agreement between your business and yourself. If you get audited, you could be in some trouble. If I'm a business with no business account and everything is going to my personal account, you are piercing the corporate veil. You might get into some trouble. IRS audits will rise. You know the rules. How are you going to play the game? So you do ignore this. It's not just your tax bill that suffers. It's your wealth. It's your legacy. It's your family's future. It all suffers. One generation can lose millions in poorly structured transfers. One law can turn a comfortable retirement into stress. But I promise you, I want you to be prepared. I don't want you to be surprised. So look at the screen, and we're going to show you the actual tax brackets. And this is the marginal tax rate. You have the marginal and the effective after all deductions and things of that nature. So this is the marginal tax rate for any deductions and credits. 10% up to $12,000 if you're an individual, and up to $24,800 if you are married filing jointly. Big difference between married filing single and married filing jointly. Big difference. Bigly. Then we have the 12% tax bracket. $12,000 to $50,000 if you're single. $24,000 to $100,000 if you are married. Only 12%, but not a lot of deductions along the way. And then the jump to 22%. $50,000 to $105,000 if you're single, $108,000 to $211,000 if you are married. 22% like that if we don't have a proper tax strategy in place. But wait, it gets worse. Like Onyx, the 24% tax bracket. $107,000 to $201,000 if you're single, $211,000 to $403,000 if you're married. 32% tax bracket. $201,000 to $256,000 if you're single, $3,000 to $512,000 if we are married. A lot of taxes that you pay. And a deduction cap. My friends, we make the same money. We're going to pay more taxes. And inflation is kicking our butt. Our pocketbook, our wallet share, our buying opportunity will go down. And if you don't have the proper structure set up, not working with the tax strategist, I continue to say that, you, my friends, are going to be in some trouble financially because of lack of planning. And then my baller shot callers, 35% tax bracket. If you're single, $56,000 to $640,000. And if we're married, $512,000 to $768,000. And the 37% tax bracket, the end of all ends, if you're single, over $640,000. And if you're married, over $768,000. You see how those numbers got smaller and smaller? As the tax brackets go up, if you're single or married, they get closer. Was that by design? No. That was to collect more money. Most successful people, it is what it is married. IRS knows that. So yeah, we get some breaks on the front end, but the people putting more money into the system, those W-2 high-income married individuals, they don't get that relief like I taught them. Now I know I got your mind spinning. And good. It should. I have a free guide that walks you through step-by-step your 2026 tax readiness. What to do now, month to month. Comments ready, REDY, or DM me ready. And I'll send you our 2026 guide that shows you how to protect your wealth. Because taxes, they change forever. Don't let them take you and your future away. Like, subscribe, share to our channel, and as always, in beautiful but rainy Jacksonville, let's make some painful or painless profits together, y'all. Peace.